Most people think retirement is about hitting a number. Could be $1 million, 5 million, maybe. But here's the real question no one's asking. How do you actually turn that money into income you can live on without stressing every time a disaster happens? Because the truth is, the old model is broken. It's worked for 40 to 50 years for the baby boomers. Save everything you can, retire, and then just hope your portfolio lasts. Hope the market cooperates. Hope you don't outlive your money. Hope you don't take too much risk, or worse, not enough. And that uncertainty, that's what keeps people up at night. In today's episode, we're flipping that entire model on its head. I'm sitting down with Ron Deutsch, Managing Director at Magnus Financial Group, who spent decades on Wall Street working with institutional investors before realizing that everyday investors were being left in the dark, especially when it comes to income. What he's built is a different approach, one that doesn't rely on guessing market returns, but instead focuses on engineering predictable cash flow so your portfolio doesn't just grow, it pays you. Think of it less like a pile of assets and more like a machine that generates income every single month. We get into 1, why most people misunderstand retirement planning, 2, the difference between growth and income, why you need both, 3, how to structure a portfolio that still pays you even when the markets are down. Lastly, the biggest mistakes investors make when chasing returns instead of managing risk. Note, this is a sponsored episode with Magnus Financial Group. But as always, the goal here is simple. Extract real, actionable insight that actually helps you think differently about your money. So if you've ever wondered how to stop worrying about your portfolio and start living off of it with confidence, this episode is going to change the way you think about investing. So let's get into it. Before we begin, quick disclaimer. Nothing in this episode should be considered investment advice. Results discussed have not been independently vetted. Any claims made by the guests have not been verified. The content is for educational purposes only. Views expressed by the guests do not reflect those of the host or this show. Hey guys, welcome to another episode of the Financial Freedom Podcast. Today's episode is sponsored with Ron Deutsch from Magnus Financial Group. He's the managing director there. He's got a background from Northwestern, Kellogg School of Business. A lot of my friends went there. I'm really happy to have him on. He's got a specific niche area where he helps retirees with income. Ron, welcome.
Thank you, Chris. Thank you for having me. Looking forward to our talk here.
We're going to blend both narrative and specifics. You've had an extensive career. You're in New York City on Wall Street. Talk about that. We'll dive into the questions.
I graduated with my MBA at Northwestern, went to Wall Street in the 80s. I became an investment banker for a couple of years. I learned pretty quickly the money was good. It was not the lifestyle I wanted. I told my mother jokingly one time, I'll never get married because I have no time to date at this point. I ended up transferring from banking into trading and sales. I became an institutional fixed income salesman. I was with Drexel Burnham Blair, with a big high yield bond house back in the 80s, went out of business in 1989. We started a 15-year career in institutional fixed income through the early 2000s. I was able to learn everything about bond investing, corporate high yield mortgage-backed securities, municipal bonds. The difference, I was dealing strictly with institutional investors, not retail, dealing with smart money people. My job was to convey ideas on how they should be investing and get them to buy into it. I had a good career. I was able to think along the lines that they thought and convey that. The bottom line is I got my whole background knowledge within understanding fixed income through those 15 years. It made me realize how little the investing public knows about fixed income, how bonds work. While I was there, I saw our retail people, brokers downstairs, selling bonds. These poor clients, what they were getting stuffed with it was abhorrent. I realized there's a big market for educating and helping individuals invest in fixed income. I stayed with that 15, 17 years. By the time I hit my 40s, I decided the institutional business was just a very fast-paced business. I felt I was too old for it. I didn't want to deal with the stresses. I took a couple of years off, did real estate investing. After that, I joined a small registered investment advisor in Manhattan. Fast forward, next 5-7 years, I stayed with them. I built up a business with clients and tailored a practice, both growth and income strategy. The growth strategy was using different stocks and other things for growth. On the income side, I was able to construct individual bond portfolios for people rather than mutual funds and ETFs. I developed a network where I could buy wholesale institutional bonds for people and build up bond portfolios. Because of my knowledge of credit, I took my CFA exam for the Chartered Financial Analyst designation. I did that while working at Bear Stearns. I was able to develop a credit strategy with the corporate municipal high yield bonds and other alternatives to build up income strategy within portfolios for my clients who needed it. A lot of clients don't need that much of it, but the baby boomer generation is the biggest portion of our population now. And that's where wealth is right now in this country. It's going to be a huge transfer of wealth in 20 years from this generation to the next one. I realized how many people no longer working wanted to figure out, how do I get money when interest rates 2 or 3 years ago were 0%? My strategy, when I sit down with people, I'll reverse engineer, asking them, let's put together a budget. Let's put together what your living style is, put a whole financial plan together. Then we'll reverse engineer how much money you need to live going forward and figure out how we can make the portfolio work for you to do that. We turn the portfolio into a growth machine, but also make it like an ATM where it's going to be kicking off cash every month you can use to pay for your needs and your expenses going forward. It's worked for a lot of clients. I've been able to avoid defaults in the bond market. I've been able to avoid other costly errors. That's how the practice has been built out. That portion of it for retirees has been a big boon. I'm able to meet people's needs doing that.
I was talking with my brother-in-law, closer friends, my generation and younger. The older generation, they were like, work 50 years, save up a nest egg, then stop working completely, live off of Social Security or investment income. The younger generation now need to live for cash flow. What's the problem with conventional retirement thinking where you just stop working and you have no earned income coming in? And how do you help clients with that?
I had a guy in his 50s, tech exec, he sold his company, well over $20 million he got back. He said, look, I don't want to work for 5 or 10 years. I might want to do consulting. I'm not sure. What should we do? We went through it from his home, kids, college needs. He said, I don't want to take a huge amount of risk. I want to make sure I've got $1 million a year coming in to cover what I need. Whatever's left over, we'll put into growth stuff. Built out a portfolio consisting of high yield corporate municipal bonds. He used private real estate debt, triple net lease shopping centers, getting lease payments. The idea of building up income level to cover it. We're grossing what he wanted us to gross, almost $1 million a year income he's getting from that percentage of the portfolio. Balance is in growth stocks. We have tech, so it's a bifurcated part of this portfolio. Last year was a great year. He made 23% on his stock portfolio, plus he made 9% on his bond portfolio. This year, first quarter was a rough quarter. He lost 7% of the stock portfolio. But the income portfolio is still paid off the cash and paid in exactly what it was. He doesn't have to worry. I look at it as two different buildings. You can buy one building that's empty, spend $100,000 for gambling. Maybe it'll be worth $200,000 in a couple of years. Or you can buy a building that's full of tenants paying you rent. On $100,000, you're collecting rent. If the market craps out, both buildings go down. The first building, you got a loss right now. You're hoping you can get back up to where it was. Second building, you don't care. You're collecting rent. It keeps on coming in. That's how I view the difference between the different buckets in the portfolio. The point is you still have income coming in to cover what you need. So you don't have to worry if values move around. Obviously, defaults could be a problem. I emphasize that diversification is big. I never have more than 1 or 2% position in any one security. But diversified, one security had a problem or two, it's not going to wipe out the portfolio. And that's a big part of what we do. I have a research department. I do my own research. Retail buys it. When things get ugly like it did this past March during the war, prices, everything went down. I went and bought more. Sure enough, it's come right back because retail panics. I like to be on the other side of that trade. I've been doing it quite a while, learned how the markets work, especially illiquid securities. You get paid to own illiquid securities, especially the bond market. Bond markets are very inefficient. When things get ugly, that's when you shove your buying shoes on, but you have to know what you're doing.
Quick pause here. If this episode is making you rethink how your income is structured, that's intentional. Information doesn't create freedom, structure does. At the end of this episode, I'm going to show you how to diagnose whether you're building leverage or just scaling complexity. Let's get back into it. A lot of the listeners out there, they're very familiar with equities, not so much bonds. What types of questions are you getting these days with Trump? Powell's going to leave next month. Presumably, he may stay at it. And then you got a new chair. How are you thinking about all those changes?
Interest rates, the big question mark. You've got budget deficits growing at levels that can't be sustainable. Eventually, we'll start crowding out debt. Rates should go higher, especially long-term rates. You've got inflationary pressures through oil, everything else, food, which haven't yet manifest themselves to the degree I think they will at some point. There may be a lag, but you've got to protect against that as well. Indeed, you're going to get an election in November. If it's a fair election and there's no screwing around, you could get a complete change of party control, which could affect how the markets will react. Typically, they would worry about more spending if the Democrats took over the House. But this administration is spending as much as Democrats. So I don't think that will affect it a whole lot. Specifically within the fixed income portfolio, we buy a lot of floating rate debt, which protects you from interest rate movements on the upside. If rates went higher, the coupons that our bonds would go higher, more income for you. We balance that with the short-term fixed rate debt. We keep the duration short, so we're not too exposed to major rate moves. 30-year bonds are something we're not buying. A lot of advisors feel 30-year municipals are always what clients should own, but that only works when rates stay low and go lower. In 2022, if you remember, interest bonds were down 13%. Stocks were down 19%. Long-term municipal bonds got crushed because as rates went up, the prices went down. If you kept it short, which we did with floating rate, we were insulated. We lost 3 or 4% that year on bond portfolios relative to the market's 13 or 14. So we insulate our portfolios on both sides that way. Flip on the equity side, we use growth as well as income for the same reasons. If you get a bad equity market, this first 3 months under Trump that just ended, dividend and value equities were up 8 or 9%, while growth was down 10%. The Mag 7 were up last year, 15, 20, 25%. You need a balance within the equity part of value and growth and dividend and non-dividend equities. It all comes down to diversification. In our firm, we don't go to shoot the lights out. If you're coming to us for 40% returns a year, we're the wrong firm. If you're coming to us where you get market-like returns with less risk, we can do that. Everybody talks about return. Risk is the other part. If someone says, I made 30% last year, my next question is, how much risk did you take? People don't know until things go south on them. They lose a lot of money and then they realize how much risk they took. When we meet with clients, we give 1 or 2 meetings to clients to get to know them, after which they can decide if they want more information, they'll go with us. Getting them to understand and us to understand what their risk tolerance really is, how much they can put up with, what they're willing to lose in a terrible market. Those are the important questions and answers you have to attack first. Then you go over their lifestyle, how they're living now, how they want to live in the future. How do you plan for that? What's the best way to use your money now to get where your eventual goals are? Planning, investing is what we do. I stick to investing and planning. The planning is the first part of what we do. That's the most important. Once you get the right blueprint down, you can figure out the answer to meet that blueprint.
You've started out in Wall Street. You transitioned to what you're doing, highly focused and specific. How do you see artificial intelligence obliterating what you're doing? How are you positioning yourself?
I don't think it's going to obliterate what we're doing at all. I've used it a little bit. It saves me a lot of time. I'll have ideas. I'll come up with what I want, and they'll come up with, all right, what else could it be? If I ask the right question, some of the stuff they give me is right. Some of it is wrong. I know what to look for, but it makes it more efficient. No question about it. I can say this. When it comes to money, I'm not dealing with a robot. I'm not going to let an AI chatbot do it. I want someone who I determine is smart and I trust in this business. Trust and competency are the two most important things you want from an advisor. I don't know how you trust a chat. The outputs are only as good as the inputs. A tool to supplement what we do, make our business more efficient, free up time. I get bogged down in a lot of stuff I'd rather not be doing, but I got to do it. That's the biggest thing. Junior positions, research analysts, you can reduce those. I'm accountable to my clients directly. I don't hide behind a group of 20 other people or chatbots. If things go wrong, people want to know who's accountable so they can talk to them about it. I don't see that happening in this business long or intermediate term. 20 years from now, it's not going to matter to me.
How do you view Bitcoin, cryptocurrencies? How is it going to play into what you're doing?
Last year, on the non-income portion of our portfolio, we had exposure, a couple percent to gold and silver. We had 1.5% exposure to Bitcoin as well. Bitcoin has become much more accepting. You can buy in the form of an ETF. That's easy. That being the case, what drives it, other than supply and demand, is hard to take. That's why I never put more than 1% or so in there. I'll put it in there just for diversification. I also always talk to the client ahead of time. So a lot of clients don't want it or don't understand it. I'm not saying I completely understand it, but it is a diversifier. I always check it with the client because a lot of people have had bad or good experiences. Gold and precious metals are something historically I never used the last couple of years, but the kind of deficits we're running right now, and quite honestly, foreign banks, the central banks of Europe and everywhere else have been buyers of gold. Everyone is worried about paper currency and inflation. For the first of my life, I'm justifying that it is an inflation hedge longer term. Even though it doesn't produce an absolute return, it is a diversifier. If we get a real panic, we'll do better. It did very well last year. It definitely had a big boost to my clients' portfolios, even though we had a couple percent in it. We have a place for it. So what I do is buy a basket in an ETF, for those of you who want to look into it. It's silver, palladium, platinum. I'd rather buy a diversified basket of metals and have it represent a percentage of the portfolio. Last year, silver went to the moon. They came crashing down this year. It's hard I'm not a trader. You got to trade that stuff. I'd rather have a sliver amongst other things and call it part of my inflation basket. I buy alternative investments for the same reason as a diversifier: real estate debt, triple net lease debt, which is secured. I have a deal based on royalties that small biotech companies sell their drugs to a big biotech company, then get paid royalties. We get paid a percentage of that. That's an income stream. I try to get as much non-diversified, non-correlated stuff into the portfolios as possible, but not have it overwhelm the portfolio. I still want the beta from the stocks, and I still want fixed income to do what it does as well. Diversification is the major theme. I've been doing client reports this week. It's crazy to see how diversification worked this past quarter. If you were in the right stuff, energy was up 37% for a quarter. If I have a 4% energy exposure, the impact on the whole portfolio with those kind of numbers was enough to make everybody feel good about things. It may flip next quarter and energy goes down, but then the other stuff, when A is moving, B should be going the other way.
What about the world, given Iran? We're trying to move towards nuclear and electric. Have we reached peak oil? How do you view oil?
I don't buy oil individually related to how we represent oil, nuclear, things you mentioned in the portfolio. One of my favorite investments is a utility closed-end fund that I've owned it for quite a while. Pays a big dividend, but also own nuclear plus the electric utilities. There's 3 or 4 all nuclear utilities a lot of the data centers are signing up with right now. They're in the fund, as well as Duke Energy, Con Ed, et cetera. That's how I get exposure to that. The fund's done excellent. It plays a big dividend. It's done what it's supposed to do. I get diversified exposure to things. It's saying it's a portfolio. I'm trying to not give people 100 security portfolios and bury them. It's much easier if I can find the right security to do that. We buy individual stocks at the firm as well. But if I can get a representation through a basket, it's a much more diversified way of doing it. As far as oil goes, I own Chevron X. I bought them years ago during COVID when oil was negative. If you remember, oil prices were negatives. We bought it a long time ago. It was cheap, pays a good dividend. Stocks went up. It'll come back down when oil prices go down. I don't care. There's certain things we own for the long term and not think about it. Exxon Mobil, if the world blows up, is one of the few companies with the people outstanding, I think. I don't lose sleep over that. We buy master limited partnerships, basically infrastructure companies. They build out the pipelines, the storage tanks for natural gas, oil, a bunch of them. The beauty of those things, not to get into today, they've got tax benefits that make them very attractive to own. They provide a lot of income, and their performance this past quarter was off the charts.
How can people connect with you and learn more?
My email address, I'm on LinkedIn. Those are the best ways. We're at Park Avenue in Manhattan. Drop in, call it. We've been around 9 years, managed $2.3 billion in high net worth individual money. I'm one of 4 advisors. We've got staff 25 people. But you're going to get customized service with us. I'm not looking to sell anybody, just looking to present it the way it is.
Excellent. We really appreciate you coming on and sponsoring the episode. Great talk. Keep up the great work.
It was a pleasure, Chris. Thank you for having me.
Let's zoom out. If you're a physician, founder, or high-income professional, and you feel like you're working harder every year, but not structurally freer, you're not alone. The mistake isn't effort, it's architecture. This show exists to help you convert expertise into scalable leverage, faster and with fewer expensive missteps. Here's the diagnostic I mentioned before. If your income requires your constant presence, if your capital isn't compounding outside your profession, if your highest value talent is doing low value tasks, you don't have a growth problem, you have a leverage design problem. And if you want to fix it with clarity instead of guesswork, I offer a limited number of one-on-one leverage strategy sessions each month. We audit your income model, capital deployment, authority positioning, and structural bottlenecks, and design your highest return move. If you're serious about compressing years into months, the link to apply is below.